Inflation is out of control. The Federal Reserve has got a major decision to make about interest rates coming up soon. An earnings season is officially underway. And from Tesla to Netflix and everything in between, there have been some major earnings reports that have come through. And today in this weekly wrap, we'll be unpacking it all. It's an easy to digest overview about everything that's happened in global markets. And there's a lot for us to discuss. So with that, let's talk about where we're currently positioned before we unpack all of the news. As we know, the S&P 500, it was trudging through a few headwinds over this past period. Using the S&P as a proxy for global markets, the S&P 500 was down for the third straight week. This was actually only the second time that this has happened over the past 18 months. The Dow Jones actually experienced its worst one-day loss since 2020, and on the same day, the S&P 500 was also down by negative 2.8%, which saw a broad-based sell-off for the Friday session. As we've mentioned, earnings season is now underway. The market's waiting to see what to make of this past earnings season, as well as a forecast for the upcoming period. And at the back end of this video, we're going to unpack a range of different sectors and companies and talk about their earnings reports in detail, so stay tuned for that. Of course, we wouldn't be discussing the past week on markets without discussing everything that's happened in the bond market. I'm sure by now you're familiar with the fact that the bond market is experiencing a significant sell-off. This steepened further, the 10-year yield rose over 50 basis points to 2.9% just over the past month. As you know, spikes in yields, especially to this magnitude, can cause jitters in stocks, and we started to see this over this past period. The VIX rose through that 25 level. The volatility index actually closed the week at 28. And just to give you a bit of an insight into the volatility on markets, the S&P 500 has traded in and through, above and below its 200-day moving average 10 times this year to date, in 2022 alone. And we're not even at the end of April yet. It's worth noting as well for the backdrop, the 10-year real yield actually turned positive briefly over this past period for the first time since 2020. And of course, when you're thinking about all of that upheaval in the markets and everything that's been playing out, you wouldn't be surprised to know that the growthier end of the market was the sector that sold off the most over this past period. As we know, those companies with long duration valuations, often found in the more growthier end of the market, have been the victims of some of the biggest sell-offs over this past 6 to 12 months, and that carried through. To give you an indication of it, the Nasdaq at the moment is on track for its worst month since 2008. And so with that backdrop, you might be wondering, where are we currently positioned? What is happening from here? As we all know, we're at record high inflations, 40-year highs. Central banks around the world are starting to raise interest rates and trying to raise rates quickly and get ahead of the curve. We know the Federal Reserve raised their first interest rates of the high cycle in March, first rate hike since 2018. The question now is, can we stick the soft landing? Or, as things continue to evolve and unfold, more so, can we avoid the hard landing is the question. The consensus from Federal Reserve and other central bank officials, as well as analysts and economists, seems to be at this stage, let's work towards neutral as quickly as possible. But then the question is, what happens from there? And where even is the neutral rate? Is it 2? Is it 2.5%? Is it 3% or through that? The question is, once we get to neutral, do we raise through that? Do we raise and wait there? Will we raise too quickly and will we need to put our foot back onto the brake? These are all of the questions that are circling around the market at the moment. And so in terms of current catalysts, the Federal Reserve's FOMC meeting is up ahead just in a couple of weeks on May 4th and the 5th. The Fed is now asking, are they too late? Are they behind the curve? And we got some very interesting insights from a range of different Fed officials over these past couple of weeks in the lead up to the May meeting. So first and foremost, the St. Louis Fed President James Bullard actually left the door open and mentioned that a 75 basis point hike was an option. It wasn't long ago that people were wondering, is 50 basis points too far, too quickly? But now the 75 basis point discussion is open. Other central bank officials said that 50 basis points is possible, with some actually leaning towards probable now. And on Friday, during the last session of the week, the Cleveland Federal Reserve President Loretta Mester stated that we don't need to go to 75 basis points, she doesn't believe. She's in favor of a more strategic and balanced progression through. However, she is in favor, if necessary, of 50 basis points, perhaps multiple times. However, for the last word on the inflation and interest rate discussion, I think it makes sense that we defer to the Federal Reserve Chairman Jerome Powell, who had a significant speech over this past week. He stated that taming inflation is absolutely essential. He left 50 basis point hike on the table for May and potentially even left the door open as well for one or even more than one 50 basis point rise moving forward if necessary. Surprising absolutely no one, he described the labour market as too hot, it's overheating, we're familiar with the metrics that are flowing through, and he did state that the Federal Reserve is willing to consider front-loading the hikes and to be aggressive early in this rate hike cycle, which potentially may leave open the door for some optionality depending on how this goes. But as we know, navigating this is a fine line. Interestingly, in terms of where the market's currently sitting now, the market's actually pricing in as much as a 200 basis point of tightening for 2022, which is a rapid uplift and obviously gets us much closer to the neutral rate, wherever that does lie. And then you might be wondering, why are we raising rates? Why is there such the focus? If you are interested in this discussion, we've done a range of other videos on the channel unpacking this question more deeply. But ultimately, to sum it up, higher borrowing costs will help to curtail demand and hopefully then ultimately put the brakes on the economy. But the question and the uncertainty is, if rates raise too quickly, are we at risk of slowing down the economy too much and then potentially risking going into the recession? And this is the hard landing that economists are discussing. It's worth noting as well that it's not just the US markets that's undergoing inflation. It's obviously not in isolation. We know that there are inflationary cost pressures throughout the global economy. And we got further insights of this as well over the past period. From the Euro area with a 7.4% inflation print, this was up from 5.9% the month before in February. UK inflation rate was at 7%. New Zealand was up to 6.9% as well. And this was a 1.8% month-on-month add. As we've mentioned, other central banks have been trying to get ahead of the curve. RBNZ raised 50 basis point hike. Bank of Canada, a 50 basis point hike as well. But there's also questions as well about, as we get towards the back end of the year, potentially, are we starting to see peak inflation now? We know that supply chain bottlenecks are forecast to begin to ease later on this year. We also know that the comps on a year-on-year basis are going to get easier from here on out after what's been a breakneck past 12 months in terms of inflation. So with all of that, there's a lot of inflationary discussions. I'd love to know your thoughts. Drop in a comment below. It's a question that won't have easy answers in the days and the weeks ahead, but we will look to continue to gain some more insight from markets as things continue to evolve. And that then brings us to the second item on the menu, and the one that a lot of people are continuing to put their eyes on over this past period. It's earnings season. Earnings season is always exciting. From Tesla to Netflix, there's been a lot of different divergent earnings reports on markets. We know that the macroeconomic picture has been uncertain and cloudy over this past period. And so investors and analysts are using this earnings season as a chance to gain some insights about where the current lay of the land is. We are still early-ish on in this early earnings season cycle. Only 20% of the S&P 500 have reported. We're around about where you'd expect in terms of earnings. The percent of companies beating estimates has been a little bit above the long-term average, but it is worth moderating that as well with the fact that there were some downwards revisions throughout the quarter due to everything that was playing out on the uncertain macroeconomic front. So potentially there may have been a lower bar for some different cohorts and sectors. So there are a couple of questions now coming through for the market. Firstly, margins under pressure. How have companies gone? What's profitability looking like? Have companies been able to pass on these rising input costs and the inflationary pressures onto consumers without seeing significant reductions in demand? And then also as well, the earnings growth outlook. How's that looking? What's the guidance looking like? We know that there is much more of a focus on guidance for this earnings season because the results have been decent, but we also know where the current lay of the land is. The question is, how will the recovery look moving forward? And then we're also looking for underlying sector trends too. Understandably, there may be some difficulties. I think investors and analysts are expecting potentially on the manufacturing and the industrial sides. But is there potentially an uplift in demand for services, for example, as we get back to a reopened economy? These are a lot of the questions that the markets are looking to answer in this period. So I thought it would be a useful exercise just for us to unpack and have a think about some of the different earnings reports that have already come through that may give us a bit of insight about where markets might head from here. First and foremost, where else would we start for this earnings season other than with Tesla? Tesla had another record report, another breakout report. It caught the street's attention. They beat on both the top and the bottom line, printed $2.2 billion in free cash flow post-capex, automotive revenues above $16 billion, 87% year-on-year growth in terms of deliveries, and it's worth noting this was in a very difficult market condition as well. Other automotive manufacturers have struggled with semiconductor shortages, supply shortages, rising input costs, of course, for the underlying commodities as well as other materials. And so the fact that Tesla was able to print a 32.9% automotive margin is absolutely phenomenal. It really did attract a lot of eyes on the street. Tesla reported high demand and they continue to rise prices throughout this past period. And they've seen no reduction in demand so far. We know there's a long wait list for the Teslas. And they've done all of this throughout this print, despite the shortages, the rising input pressures, and the Shanghai factory temporary shutdown as well, which is now just starting to come back online slowly. There was an interesting discussion as well from Elon Musk with the recent earnings call, where he stated that any entrepreneurs looking for opportunity should look to enter or consider the lithium business. The margins are like software margins at this stage, and tongue-in-cheek slightly, he stated if you like minting money, then lithium would be the sector for you. If you're interested in understanding more about Tesla's recent print, as well as the lithium sector, supply and demand dynamics, we did a video deep diving into this, so we'll leave a link to that up above, and you can check it out after this video. Onto the second sector or cohort. It's the airlines. A few really interesting prints from airlines over this past period. We know with the mobility restrictions, the border closures, and everything that's played out with the virus, it's been a difficult past couple of years. But United Airlines, along with Delta, actually guided for a 2022 profit, which took the market by surprise. United Airlines stated that their Q2 will be the highest revenue in company history, and American Airlines got in on the act as well, with America's largest airline forecasting a Q2 pre-tax profit. Of course, this provided a boost for the airline and the leisure sector. It gave some excitement about the potential for the reopening trade demand moving forward. And we can see that this strong demand actually helped to offset, of course, the rising fuel costs, with the price of oil and jet fuel rising during the past period. Onto the other side now as well. A more difficult headwind was the Netflix side. I'm sure many of you are familiar with the Netflix print by now. The share price was down by over 30% on the day after their earnings report. They lost subscribers for the first time in a decade. Of course, this was a company opposite really to the airlines. It was a big beneficiary of the stay-at-home trade and with the lockdowns. But Netflix lost over 200,000 subscribers in a quarter where they were forecast to add subscribers. But what really scared the market even more, I believe, was that they guided for another negative 2 million subscriber loss in the upcoming quarter, which really took the market by surprise. Of course, they highlighted a few different factors contributing to the subscriber loss. Account sharing was one of them. The fact that the macroeconomic picture was uncertain was another one as well. But this did cause a lot of uncertainty for the streaming sector. We saw some share price weakness from a range of different companies, including Disney and Roku. And we actually saw CNN Plus was to shut down after just 1 month. So it's been quite a fascinating period from the streaming sector, and we'll see what's up ahead from here. Again, similar to Tesla, if you're interested in learning more about the Netflix earnings report, we did a video which we'll leave a link to up above where we deep dove into that discussion too. Staying on the social media front, Snap. Snap is a company that's always attracted a lot of market attention. They serve as a bit of a proxy as well for the social media sector more broadly. Snap missed on both the top and the bottom line with their earnings report. But there was an interesting dynamic at play here. They forecasted weak revenue growth. But what was interesting for Snap was that their daily users actually grew 18% year on year, which was more than expected and higher than consensus estimates. So what this speaks to here is the concerns about demand for advertising services, even though they have strong user growth there. And what's really fascinating is what this potentially could mean for the economy moving forward. Obviously, their advertising customers are navigating through a range of headwinds. We've talked about them on the channel before. We're familiar with them, from the supply chain disruptions to labor shortages, obviously inflation, as we've just unpacked there, and rising interest rates. So the question will be, how will this affect upcoming earnings reports as well from, say, Alphabet or, say, Meta, who are also advertising revenue reliant in terms of some of their core revenue drivers? And then another discussion too was Procter & Gamble. Using this as a bit of a proxy for the retail and consumer goods space, Procter & Gamble is one of the largest FMCG companies in the world. The question for this space is, how are they going to be able to deal with rising input costs? Would this affect their margins and ultimately profitability? We saw Procter & Gamble, they beat both on the top and the bottom line. They actually raised their forecast for revenue growth, and they did leave a mention of the fact that they expect inflation to rise in the next quarter. However, they were able to pass on price hikes, and through productivity savings, this helped to offset their inflationary impact on margins, which actually answered a lot of questions, and it's going to be fascinating to see as more earnings reports come through. As mentioned, we're only 20% of the way through this earnings season, whether we see similar trends through other retail and consumer-focused companies. And that then leads us to the week up ahead. This week of earnings is absolutely stacked. There's a lot of mega cap technology names, many of your favorites from Apple to Amazon, Facebook, Amazon, Alphabet, PayPal, and Twitter. We know that so many of these are significant weightings and large constituents on the S&P 500. And as a result of that, these earnings reports do have the ability to drive the trajectory and the direction of markets moving forward. So it's going to be fascinating to see how these numbers come through. I'd love to know your thoughts. Drop in a comment below. If you're interested in discussing more of the macroeconomic picture, we'll leave videos that you can check out after this one, unpacking the space. A big thank you for joining us. For now, stay well and happy investing.